Hi, so today we're talking about the trading account. The trading account is an account which we record what we take in as a business and what we take out. So to get it easily, you have to take yourself into the old days whereby we used to trade goods and services by giving another person goods, then the other person would give us goods. So you would take in goods and then take out goods. So maybe you would come with your car, then I would give you maybe my house. That's a trade. So in business context now, these days we get money. So what we do is we take in purchases, right? In the business context, we take in purchases and then we take them out as sales. So as we take in those purchases, we process them or maybe rebrand them and then put a profit markup and then sell them. That's the trading, right? So that's all about the trading account in summary. But then we're going to dig deeper. There's a lot in the trading account and we're going to talk a lot in it. So stay tuned and let's go.
So let's talk about the trading account now directly. The definition is the trading account is a financial statement that shows your company's income and cost of that income. What do we mean by income and cost of that income? Income, when you're a company, your income comes from sales mainly, right? So by saying your incomes come from sales, what we mean is your income is recorded as money that comes from your main trade, from your trade, right? So your main trade are your sales, what you sell on a daily basis, what the company does on a daily basis, what you do when you wake up in the morning on a daily basis as a company. What do you sell? What do you stand up for and say, we sell this? That's what we mean by your sales. So that's what should be included in sales. What I'm saying is, an example could be, you are a company that sells ice creams, which means your sales should be recorded as ice creams. So what you make out of those ice creams, the money you get from those ice creams, is what you record as sales. If that same company which sells ice creams then sells a building which they used to manufacture ice creams, we do not record that as a sale or income in the trading account. Why? Because that's not your trade. You do not sell buildings on a daily basis. So we have already covered the sales part of the trading account, and right now I'm just dealing with the definitions just to simplify and help you get into the trading account, understanding the terms in the trading account and knowing what gets in and what doesn't. So in the trading account, under sales, only things that you sell on a daily basis enter the sales part in the trading account. I hope you're clear there. So your sales are your income. I've cleared the income part. Now let's go to the cost of that income. What is the cost of that income? The cost of that income is what you have put out as a company to get goods into the company so that you may maybe rebrand them or maybe reprocess them or add value to them so that you can then resell them. So what is an example of this type of a cost? An example of this type of a cost could be purchase cost. By purchase cost, I mean the money you put out in paying to get those goods, right? So this may be the money you put out in transporting the goods from point A, where the goods were manufactured by the manufacturer, to point B, which is where you are redeveloping them or increasing their value or maybe rebranding them. That's an example of that cost. So the cost of transportation from the manufacturer's warehouse to your firm or to your organization. So that's a cost of that income. Why? Because you are then going to resell the goods later, and then when you resell them, they are called sales. So these are the cost of sales. By cost of sales, we're saying these are the costs of income, right? Now let's go deeper. We have the purchase cost. We have the purchase cost in the form of transport cost, and then we have the purchase cost in its own form as a purchase cost. It stands alone as a purchase cost. What do we mean by it stands alone as a purchase cost? We're saying you go and buy the goods, right? The wholesaler will say to you, these goods are priced at $200. So $200 is the price which you are going to buy the goods at from the wholesaler. We call that the purchase cost. It's the money you're putting out to purchase from the wholesaler, right? So that's the purchase cost. You give the wholesaler the money, the wholesaler gives you the goods, so you have incurred the cost. You have incurred the cost of purchasing those goods. Let's take another example. Another example could be customs duty. By customs duty, I mean you are a company that buys goods from outside the country and then resells them in your country. So customs duty is charged at the border, right? The customs, right? Do you get it there? At the border where two countries divide, that's where the customs duties are charged by the government of your country or of the other country. So when these customs duties are charged, you should charge them, you should actually add them to the cost of the goods you are going to sell. So we are applying what we call the matching concept here. We are matching the cost of those goods to the income of those goods. What we are saying is you have incurred the cost as the border, right? They have charged you for bringing those goods into the country, so you have to put that cost onto those goods. Why? Because those goods are the ones which were charged that expense. So it's the cost of that income. So I've given 3 examples and I think they're clear, but you'll get it more when you get deeper. So basically those are the 2 classes of items we have in the trading account. We have the cost of sale and the sales. So we have the sales and the cost of sales. However, we are going to unfold a lot of things in the cost of sale item, and in the sales not much. So let's get it. So let's talk about the trading account format. The trading account format begins with sales. Like I have said, the main components are sales and the cost of sales. So you see sales in the first line, and then cost of sales is a subheading in the second line there. So if you check sales also, it's only sales and they are only sales themselves in that part. However, cost of sales have a lot of items in them. We will talk about those later too. So the sales are in income, and remember in the trial balance, what do we do with sales? Sales are credited, so we just put them on the right side of our statement to show an appreciation of crediting, right? So we credit sales, we just put them on the credit side. They are income, so they are put on the credit side. Let's talk about the cost of sales now. The cost of sales include in opening inventory or stock. I would like to call opening inventory a historical purchase. By historical purchase, I mean goods which you purchased in the past. So opening inventory is goods that were purchased in the previous month but were not sold in that month. So we may have to sell them this month or maybe next month, but we still have them from last month. They are not goods that were bought in this month or in this period. These are goods that were bought from a previous period, we can say last year, but then they entered this year. Let's say we're in 2021. We're saying these goods were from 2020 and they're now in 2021 because nobody bought those goods, right? So that's opening inventory. So what do we do with opening inventory? Under cost of sales, we do not mix the components of cost of sales with sales as individual items. We have to group the cost of sales items on their own. So if you check on the statement, the cost of sales are on the debit side, right? If you check them, cost of sales, I've put them on the debit side. So if you check, opening inventory is on the debit side, XXX on the debit side. As I've explained opening inventory, I will now explain purchases. Add purchases. Remember what I said previously, purchases also include transportation costs of coming with the goods to the company, the cost of actually buying the goods from the manufacturer or from the wholesaler. So those are the types of purchases you may have, or you may have customs duty on the goods. That's a purchase also. So now we have opening inventory and we have the purchase costs, and we call them they are part of the cost of sales, right? Remember, we're putting them on the debit side. So you say opening inventory, then you add purchases, right? Opening inventory is a historical purchase. So we're saying we are taking goods from the previous month, which is the opening inventory. We are taking purchases from the previous month. These purchases are the opening inventory. It's only that they are now a historical purchase and they are now called opening inventory, but instead they may have, to make it easy, you just call them a historical purchase. So purchases have to be added together. So we're adding opening inventory stock to purchases. These purchases, we're saying we're adding opening inventory to purchases. These purchases are purchases from this current month, the purchases that we made in this month or in this period. So we're adding purchases from the previous period to the purchases we made in this period. And they give us triple X down there. Then we say less closing inventory. Closing inventory is saying we sold goods in this month or in this period or in this year. We sold goods, but then there were goods that were not sold. These are the goods we are saying less closing inventory, or they may say less closing stock, depending on your syllabus, which words you use mostly. So less closing inventory, we put that in brackets. Remember, we're still on the debit side. We're still dealing with the cost of sales aspect of the trading account. So you say opening inventory, add purchases. When you get the total of those two, you say less closing inventory. Then you get a figure that we call cost of goods sold. This figure, which is called cost of goods sold, is then transferred to the credit side, right? So this cost of goods sold can also be called cost of sales. Why? Because goods sold are called sales. So we're saying cost of sales, cost of goods sold, it's one and the same thing. So in the exam, the accountant loves to play with those words and loves to confuse people. Now, you shouldn't be confused when such terms come. Why? Because now you know goods sold are sales. If you sell goods, right, we're saying goods sold. That's the past tense. They were sold, right? You sold goods, which means you made a sale. So cost of sales are cost of goods sold. So this figure we call cost of goods sold, which you have put now on the credit side, you then less it from the sales figure. Remember, we still have the sales figure up there on the credit side. So we say sales minus the cost of goods sold figure, we get what we call the gross profit or loss. By gross profit or loss, we mean the cost of goods sold figure may come out bigger than the sales figure. This means that you have incurred a gross loss. Why? Because your costs are greater than your income. The costs you incurred in purchasing the goods which you sold are greater than the income which you incurred in selling the goods. However, if it's a profit, we are saying your sales are greater than the cost of those goods which you sold. So basically we're saying you have made a profit, you have gained something from there. So it's not much about the trading account. That's almost all about the trading account. All you have to do now is practice the format, and accounting is about practicing. What you have to do is get that trading account format into your head. First days you may cram, and with time, with practice, it sticks in your head. You no longer need to revise the statement. Why? Because it's stuck in your head, right? But practice makes perfect. Always practice questions and get the format in your head. Repeat the video. The beauty of videos is that you can repeat it whatever time you want. You can revise it whatever time you want. That's the beauty of videos. So remember, this was an introductory lesson, and we'll be expanding on the purchases aspect later on in another video, and also continuing to the profit and loss account. So this is the profit, the gross profit or loss we've got there. We also have what you call the profit and loss account. That's an account in which we include many expenses and many of the general expenses and many of the other forms of incomes that the business may have, and other benefits that we will discuss in that lesson. So I hope all has been understood, and you can repeat where you didn't understand, or ask me. I'll post some contact details if you want to ask some questions and stuff. And good luck in whatever you're doing and in your endeavors. I hope you succeed.